Good afternoon. It's Jeff Christian of CPM Group. It's actually Friday afternoon, August 6th, about 2:30 almost. Running a little late today for a couple of reasons. One is the markets have been very busy, and the other one is that I am on a virtual roadshow with South African institutional investors. So all of this week and into next week, I'm getting up at 4 a.m. and I'm making presentations on the outlook of the economy, PGM markets, and gold to institutional investors, basically from 5 a.m. New York time until about 10:30 or sometimes 1 o'clock in the afternoon, our time. So I've been tied up with that. As I said, the markets are very busy today. And if we look at it, let's see, the dollar has crashed, the stock market has crashed, Treasury interest rates have skyrocketed, unemployment is soaring, silver's $100 and gold $10,000. Oh wait, I'm sorry, that's somebody else's fantasy, if I may take a cue from Lorde. No, it hasn't been that way. Gold fell sharply and silver fell sharply today after very good employment figures came in, pointing out that the US is moving from a recovery phase in the economy into an expansion phase, even with all of the problems. Interest rates actually have fallen back. US T-bonds, T-bills bonds, 10-year bonds are back down to about 1.23%, close to the 1% where they started. The dollar actually rose sharply today, and the stock market is at record levels. In other words, the world isn't crashing, stock market's not crashing, global economy is not crumbling, and the dollar is not in a free fall. All those things that the perma bulls love to tell you are occurring, and we're saying no. So today I want to talk a little bit about where we are in the markets. Obviously, I'm a little punchy because, frankly, we had said that the gold price and silver prices were likely to fall. We're looking for the possibility of a fall price below 1780, which we're seeing today. And we've been telling our clients and we've been telling other people through these videos and elsewhere that the possibility of a spike down as low as 1680 is possible during the course of August. So I want to talk about where we are now and where we see the market going. And I also want to spend some time on the economy, the dollar, interest rates, equities, and inflation. As issues that a lot of investors around the world, institutional investors that we service directly, and retail investors and others have been asking about. And the fact that perhaps we've been a little bit better than some of the perma bulls and snake oil salesmen in saying this is where the market's going has caused a lot of people to say, hey, Jeff, talk to us about the economic environment. So I'll talk about that. And then I'm going to throw two trite facts out. These are facts that are kind of trivial, actually, but they speak volumes about the state of financial markets. And they speak volumes about the extent to which some of the stuff that people talk about and trade as perceived wisdoms are perhaps not very wise. So a lot to cover today. Let's jump into it. Current market trends. We've been saying for some time, July and August, seasonal weakness, possibility of prices come off. We had been saying that we thought that the prices would show some strength in late July as we saw the roll of the August COMEX futures contracts into December. That did happen. Gold did go up from about 1792 in mid-July up to 1837 last week. It came back down, it broke below 1800, was testing 1800 yesterday. This morning, when the jobs report came out in the United States, gold fell sharply. And it got down to, I think, something on the order of 1770. It's below that 1780 support level, and there is a possibility of further weakness. We actually issued a gold trade recommendation today, which is available for free via GoldX app and via Kitco. And we said, look, if you were short, the way we had suggested that you should be short on a short-term investment basis, if you were short gold, you should probably take your profits now, because we do think the price might come back over the next couple days over the course of next week, but we still expect further price weakness, seeing it possible over the course of August. So it might be a good time to take profits. Some of our investors we know who listen to us have taken profits on short positions today. One fellow with an options position is up about 137% on that position. He's kicking himself because he didn't do more. But 137% of anything is worth something. It's worth 130%. So we also issued a silver recommendation. Silver, we have been saying for some time, could easily fall down to $24, $24.50. It broke below $24.50. I think it got down to $24.20 today. We have also been saying that over the course of August, it could drop as low as $22. Not ruling that out, but this would be a good time to take short-term profits. And from a longer-term perspective, excuse me, a little tribute here. Yes, it's blood. Anyway, from a short-term, from a longer-term perspective, $1,800 is a good price to buy gold. Central banks have been buying a lot more gold since March, around $1,800, which is extremely bullish because these guys are price sensitive and they've stepped up their gold purchases, saying to the world, $1,800 is a good place to buy gold. We've been telling our clients, yes, $1,800, if you're a long-term investor, this is a good place to buy gold and gold shares. But you might want to wait and you might be able to get them at bargain basis prices over the course of August. And probably if you don't see those prices spike down, you'll still be able to buy at $1,800 in late August or September. So you really haven't lost anything in terms of exposure. We didn't think the price was going to 10,000. We didn't think the dollar was crumbling. So far this month, it looks pretty good. Over the next 4 months, beyond August, we do think that the gold price and the silver price will start to rise again. Modestly, we're looking for modest increases in gold and silver prices for the last 4 months, 3 or 4 months of 2021, and really over the course of 2022. We do think prices will rise more sharply later when we get into a recession and a financial crisis. But that's the subject of my next video. That's actually 2022, 2023 and beyond. Before I get there, a little bit of what we're seeing here. This is ETF holdings of gold, and it goes back to the beginning, but if you look at it, 7.4 million ounces net sales in the first half of this year, and about 660,000 ounces sold by the top 5 funds last month, less in total last month. But you've seen investors, 2 sets of investors. One is stable liquidation. Price hasn't been rising. The stock market's been rising. I'm pivoting out of gold into stocks for now. But you've also seen disenchanted investors. I've talked in the past about the fact that you have a lot of investors who are new to gold and silver, who have joined into the gold and silver investment community, really starting in the middle of 2019, when false prophets, if you will, were saying that the inverted yield curve would lead to a recession imminently. We did get into a recession in 2020, but not because of the inverted yield curve. That's a long discussion as to why the inverted yield curve no longer is particularly relevant to overall economic activity. But we saw investors, new investors, starting to come into the gold market and the silver market in the middle of 2019, and then again in the middle of 2020. And then to a lesser extent in the first 3 or 4 months of this year. And frankly, one of the reasons why we started doing weekly videos was because a lot of these newer retail investors and institutional investors were asking us for guidance and didn't want to pay our consulting fees. So we're seeing some investors disenchanted. They bought gold when it went from $1,800 to $2,000 last July as the August COMEX was rolling. After we got into the first week of August, gold came off and it fell actually for the rest of the year. And it got down to a low in December before it started rising a little bit again in the early part of this year. And a lot of those investors said, wait a second, you know, I was watching the other guys on the internet, and other guys on the internet were saying that gold's going to 10,000, silver's going to 1,500 or 13,000, the stock market's going to collapse, the dollar is going to collapse, the financial system is crumbling, and none of that's happened, thank God. But gold and silver actually have fallen back Silver's not $100. It's not even $30. Gold's not $5,000. It's not even $2,000. So you've got a lot of investors who've gotten disenchanted. They were sold a bill of goods. Gold and silver still make sense as investments, but for reasons other than what the perma bulls tell you. And in fact, we wrote a report for a client just recently saying gold, the title of which is Gold is a Good Investment Despite what Gold Bulls Say. You've seen some liquidation in the silver market. It's up for the full year because you had a surge in February, March. We actually saw a decline. The top 5 were off about 2 million ounces over the course of July. If you look at all of the 20 some odd ETF, silver ETFs that we track, the total was off less than that. I think about 500,000. It doesn't really show here. It's hanging up tough. Silver investors are holding on more than the gold investors. So let's turn to these other factors, because this is what drives a gold and silver investment demand in the long run. Yes, we had a very deep recession in 2000. On a global basis, we're in the recovery phase. China and the United States are now in the expansion phase, by which we mean that overall economic activity as measured by real GDP is greater in the second quarter in China and the United States than it was in the fourth quarter of 2019. So we are moving toward an expansion. There are a lot of problems that existed before that have gotten worse or continue. And we're very much concerned that we could see another financial crisis and another recession at some point in the near future. Yeah, prior to 1980, recessions occurred in the United States every 6 years or so. From 1980 until 2008, they were running every 10 years. Then we had 2008, which is this big spike down here, and then we had 2020. Our concern is that we could see a recession as early as 2023, but we've built it into our economic model 2023, 2025. That would be good for gold and silver because of their safe haven and portfolio diversification. And quite frankly, we expect gold and silver prices to rise to record levels, both in real and nominal terms, during the next recession and the next financial crisis. And we're putting a wet finger in the air. It's very hard. It's impossible to econometrically say this is when the next recession is going to occur. This is how deep it is going to be. This is how long it's going to last. But we put a wet finger in the air and we say, okay, we think it may be as early as 2023, 2024, 2025. And the fact that that coincides with the next US presidential election is not purely coincidental, because a lot of the political problems, both domestically around the world, it's not just the US that has severe domestic discord politically. Talk with Hungary, go throughout the EU, go to England, China, Russia. You have a tremendous amount of domestic political unrest, and you have a tremendous amount of international political disconnections. China versus the US, China versus Europe, Russia versus everybody else. So you've got a lot of problems that are just over the horizon. And the constraints on international trade could be a major factor in stimulating the next recession and the next global financial crisis. So we're watching out for that. We do think that gold and silver prices will rise when that occurs, and it's our economic view. I used this last week, and I've gotten so many positive comments on this. This is from a company that I won't name, but it's from July 24th, 2 weeks ago. The dollar's already in a free fall. And, you know, I pointed out, this is March through July, although they say it's August, and they took the scale off. So oh my God, look at this enormous drop in the dollar. The dollar's collapsing. It's in free fall. I told you, I've been telling you since 2009, one of these guys said last week. I've been telling you since 2009 that the dollar is going to crash and it'll be worthless. And now it's happening. I'm only, 12 years ahead of my time, except that the dollar's not crashing. This circle represents that decline. The dollar has been trading in this range since 2015, and it's gone from the top of the range to the bottom of the range. And it's still far above, like 50% above, where it was in a range from 2005 to 2015. Dollar has problems, long-term problems, but other currencies have even bigger problems. So the dollar is not collapsing, despite what you've heard on late night infomercials. And the interest rates, while they rose in February, March, remain at historically low levels. We are far from having high interest rates, and we're far from having interest rates so high as they negatively affect gold and silver investment demand. And even if you just go back to 2019, 2020, the first half of 2020, interest rates remain low. And they've come back off to about 1.23, I think, today for 10-year bonds. Adjusting it for inflation, you're very low. These are T-bonds adjusted for inflation. And I have to point out, we've had negative T-bond rates since sometime in 2019. And we had a bout of it in 2011 to 2013. So when you see these guys saying, oh, now we have negative Treasury rates on inflation adjusted basis, this changes everything. No, it doesn't. Okay. They made a big amount of hay on the dark corners of the internet about how we now move to a negative interest rate. These are T-bills, short-term Treasury interest rates. They've been negative for most of the time since 2008. We are 11 years into a radically changed financial system. That means that anything that you can say, well, from World War II until 2008, this was the way the financial system worked, probably is largely irrelevant. You heard this in 2019. Oh, inverted yield curve always coincides with a recession. Well, maybe sometimes a year into the recession, maybe sometimes 2 years before the recession, sometimes concurrent. But the fact that we have a negative yield curve means we're going into a recession if we're not in one already, because since World War II to 2008, it's always coincided more or less with a recession. And we kept saying, no, 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 no. After 2008, the financial system was changed dramatically. Some people would say for the worst, some people would say for the better. But it's changed. And the relationship between an inverted yield curve, for example, and recession and overall real economic activity is changed. So what happened and what was relevant prior to 2008 may not be relevant now. Similarly, we've had this extended period of negative nominal rates in Europe and Japan. That's one of my facts that I'll talk about. And you've had this extended 11-year period of negative T-bill rates adjusted for inflation. And Jerome Powell last week said, you know, we may have negative inflation adjusted T-bill rates for another 10 years. Saying, okay, it's been 12 years now, we're talking 22 years. And I happen to think he might be right. And then you get the pundits on the internet saying, oh my God, we've now gone into a negative real interest rate environment for treasuries, and the Fed thinks it could last for a decade. The Fed is saying that everything that's been going on since 2008 could last for another decade. And we agree with them. In fact, we've been saying since 2000 that a lot of this stuff was going to happen, and it wasn't a matter of 1 or 2 years of hostile economic conditions. It was decades worth of hostile economic and political conditions that were going to cause the investment demand curve for gold and silver to shift upward, and more investors would buy more gold and silver at higher prices for a longer period of time. We called it the Golden Renaissance in 2000, 2001, and thereafter. And that has in fact been occurring. And it's been occurring for 20 years, and it's going to continue occurring probably beyond 10 years too, because we're going through a massive transformation on a global economic, financial, monetary, and political basis. And there are certain engines in place that are rolling down the track, and we're probably not going to change them. And they're probably not going to unfold the way some people think. So you've got an extended period of time of negative real interest rates in treasuries and negative nominal rates in other markets. If you look, the scatter plot here is changes in the gold price, the real inflation adjusted gold price, because that's what matters, and changes in real interest rates. And you can see at the bottom, the correlation is 16%, negative 16%. So Gold doesn't necessarily trade against interest rate changes the same way it doesn't necessarily trade against the dollar or inflation, because it trades against all of them. And sometimes the dollar is important, and sometimes interest rates are important, and sometimes inflation is important. But what you see are large periods of time when interest rates and gold prices are both falling, or they're both rising, or one's falling and the other one's rising. So it's not a matter of higher interest rates affecting gold. And then on the right-hand side, these are real interest rates. These are gold price changes based at different levels of real interest rates. And you can see, negative 3% interest rates, all the way up to 1% positive real interest rates. And they don't necessarily have an effect on gold prices. Gold prices tend to rise in those environments. And that makes sense because real interest rates of 1% are not particularly thrilling. It's not going to cause you to say, oh gosh, I'm going to sell all my gold and throw all my money into treasuries because I can get 1% adjusted for inflation. If you can get 3% or higher, then you start saying, well, maybe I should sell some of my gold or buy less gold and put some more money in the treasuries. But it takes 3% or higher real US interest rates to have a negative effect on gold over the last 50 years. So there's, well, that's history, it doesn't really apply. I just said that myself about a variety of other things. But historically, over the last 52 years of free gold prices, that's been the relationship. So 3% real interest rates. If you've got 2% inflation, that's 5% nominal rates. If you've got 4% inflation, that's 7% nominal interest rates. I don't know any legitimate economist or prognosticator who's talking about 5 to 7% nominal interest rates on US treasuries in the near future. I mean, maybe someday, but probably not in the next several years. Let's talk inflation. Inflation is not a problem. We haven't gone into hyperinflation. We did see headline inflation around 4.85% in the most recent month. And we saw core inflation, which takes out energy and food, around 4%. A lot of that, in fact, is transitory. And if you first look at it, it's base. So you're going from the second quarter of 2020, which is when the world locked down, and oil prices went to $20 a barrel in the real market, and actually were negative for a couple of days on the April NYMEX contract because there wasn't enough storage capacity for the excess oil that was built up in the West Texas Cushing oil terminal, Cushing, Oklahoma oil terminal, where West Texas Intermediate crude is stored. So you're going from the second quarter of 2020, which is a really negative time, where nobody was buying anything because they were locked in their homes, to the second quarter of 2021, when everybody's coming out and saying, oh, I can buy toilet paper again. You saw a 45% increase in oil-based energy products. You saw a 40% increase in used cars because people are buying cars because they're moving to the burbs and smaller towns, and they need cars to get around. So they need one car, or they need two cars, or they need three cars. I've told my wife, if we ever leave New York, we're going to need at least a 3-car garage, because there are all kinds of cars that I want to own that I don't own in New York City. I rent them. But you're seeing used cars because the chips are limiting supply of new cars, and you're seeing oil. Food bought in restaurants rose 9% in June. That's because the restaurants were shut down for 12 to 15 months. They were reopening, and they were raising their prices to try to rebuild their financial situation. It was not because they're paying their workers more. Real earnings per hour actually fell 1.7%. So it wasn't a matter of some communist-inspired minimum increase in the minimum price wage. It wasn't because the restaurateur said, I can't find anybody who wants to work for $2 an hour, so I have to pay them $4 an hour. It was because they were raising their prices, not because they were raising the salaries that they pay workers. That has to be resolved later. Food bought for consumption in the home rose less than 1%, 0.9%. 1/10 of the price for food in restaurants. So, and that is in an environment where more and more people are eating more and more of their meals at home again, the way they did in the 50s and 60s when I was growing up, and less in restaurants. But so you're seeing inflation as a transitory thing, but that's okay in terms of a gold investment. So we don't see it high. We also see it low, and it's been low and it's fallen lower since 1982, 1983. We're not worried about money supply per se as being inflationary because, again, 1982, you saw a 15% increase in narrow money supply, which was translated into a 38% increase in broad money supply, because as that money was poured into the market, into the economy by the Fed to get us out of the double dip recession from 1980 to 1982, which was threatening the sovereign debt of Argentina, Brazil, Chile, and Mexico. As we poured money into the economy by buying bonds, that money was lent and spent and got us out of the recession in 6 months' time. And you've seen that Volcker practice repeated in 1982, 1987, 1991 recession, 1997 is the Asian currency crisis, 1998 with the Russian sovereign debt default, the 2001, the tech bubble burst and the 86% decline in NASDAQ and the recession, 2008, 2011. You've seen it over and over again, where you see this massive amount of money put into the economy by monetary authorities to get us out of a financial problem. And then they withdraw it by selling bonds, sucking up the excess liquidity once we're out of that crisis. And as a result, there's been no inflationary consequence up until now of monetary largesse. Now, fiscal spending, the money that's come off to individual consumers and small businesses and large businesses over the last 15, 16, 18 months, that's a different issue. This is monetary accommodation and stimulus, and it hasn't been inflation. Now, we're very high here, so that could be worrisome. They're going to have to sterilize a lot of money if and when the economy starts returning to some new normal, and it's not there yet. But look at this, 65% growth in M1, and broad money supply is less than 30% growth. The money that is being given out fiscally is being spent by businesses and consumers. The money that has come in through money supply is sitting in banks, in bonds, and in the stock market. The reason why the stock market is moving to new highs throughout the pandemic and recession, and really over the last 11 years now, has little to do with underlying economic activity. It has everything to do with the fact that a lot of money has gone into banks and they're buying bonds and they're investing in equity derivatives, and they're earning 5 or 6%. Now, that's important when I get to my trite facts, because you say, why would anybody buy a bond from a government that has a negative nominal rate? You're paying people to hold your money. Well, I'm paying them 25 or 50 basis points. I'm getting assets, which I can use as collateral to buy equity derivatives with sometimes guaranteed returns of 5 or 6%, sometimes non-guaranteed returns of 5 or 6% or much higher. I'll make that trade every day. Some guys will say, well, this is terrible and the world's going to collapse as a result. Other people say, yeah, well, if it starts to collapse, we'll have to do something about this. But until it starts to collapse, since this has been going on really since 2008, I think I'm going to do this for myself. And if I'm a fund manager, I have a fiduciary responsibility to my clients to try to make money for them. And this is probably the easiest way to make money. It's inflationary to stocks, it's inflationary to bonds, but it's not inflationary to the day in, day out consumer and producer goods and services that show up in the CPI, PPI, and other non-financial inflation indicators. Now, don't worry about it if you're a gold investor, because the reality is inflation hasn't been a problem since 1982, and the gold price has gone from $320 an ounce in 1982 to $1,800 to $2,000 an ounce last year. So gold prices are rising because investors are buying gold for reasons other than inflation. CPM Group, in our reports, we always talk about the 6 sets of factors that drive investment demand. And inflation has been the weak link for 40 years now. Other factors like stock markets, bond market, interest rates, overall economic activity, political unrest, either domestically or internationally, concerns about banking and financial market stability. Those factors have caused investors to buy gold, more gold than ever before. The investment demand curve since 2000 has shifted upward, and more investors in more parts of the world are buying more gold at higher prices for a longer period of time than ever before in history. And that's going to continue. It started to emerge in 2000, 2002, and it's been going on ever since, with a little bit of an interruption between 2013 and 2019. So don't sweat the lack of inflation, and don't worry about hyperinflation. 2 trite facts. Here's one. There are $16.5 trillion invested in bonds, mostly European sovereign bonds and Japanese sovereign bonds, that have a negative nominal yield. Now, again, the perma bulls for gold say, oh my God, this is insane. Why would I do this? Well, I just explained why you would do it. Because I can pay you 50 bips, 0.5%, and I can make 5% on that money. Okay, I'll do that. $16.5 trillion in negative yielding bonds. We estimate there's about 1.4 billion ounces of gold held by private investors at $1,800. Well, I did this a couple days ago. It was 5th of August. So yeah, it was $1,800 yesterday. $2.5 trillion. Investors of the world hold almost 7 times as much negative yielding bonds as they hold gold. The perma bulls will say, oh my God, this is insane. They should be holding gold. Don't they know the bond market's going to collapse? Well, they know that the bond market could collapse at some point in the future, but they have watched it not collapse for 30, 40 years, while the perma bulls keep saying, hey, it's going to collapse. And someday I will be right. So you've got 7 times as much money invested in negative yielding bonds as in gold. I think that's way too little gold. You know, we recommend a lot more of your wealth to be in gold than that. Now you say, okay, well, a lot of those negative yielding bonds are actually held by other central banks and monetary authorities. So let's throw that in. You have another 1 billion ounces of gold. So you have 2.5 billion ounces of gold held by investors and monetary authorities. And at $1,800, that's $4.4 trillion. So you only have about 3.75 times as much money in negative yielding bonds than in gold. There's several points to take away. First off, the world's underinvested in gold, which is good for gold bugs, good for gold investors, because the price of gold ought to rise as people say, I think I should have more gold. And the other thing is that all of those negative yielding bonds, some of which have been around for 11 years now, 12 years now, 13 years now, probably are not as toxic as the carnival barkers in the gold market would have you believe. That's one trite fact. It's kind of trite, kind of off to the side, but it tells you something important about the financial markets and their effects on the gold price. Something that you don't hear at the Kmart. Sorry, apologies to Kmart. The other one is the myth of Chinese government. Oh, the Chinese government's going to jump on the Treasury. Chinese government has all these Treasury bonds. I had this table in a presentation 3 weeks ago, which I call Treasury Truth. And I still want to go back and expand on that Treasury Truths discussion, because there are other things I didn't say. But we've just been really busy the last 3 weeks and I haven't gotten to it. And I thought I would do it this week, but then I thought, it's more important to go through the things that I've been going through. But we had this table there, and it was, okay, $28 trillion of US federal debt, but 18 trillion of it, 17 trillion of it is owned either by US government agencies or by the Federal Reserve. So you're really talking about $11 trillion, and of that, $7 trillion is held offshore by somebody or else. And it's not China. Of the governments that report how much US treasuries they own, the Japanese government has 1.2 trillion. The Chinese have less gold, US treasuries than the UK government. The Chinese government has about $439 billion of US treasuries. And yesterday, the Chinese government, yesterday, Chinese government said, oh, we have $337 billion of Chinese government bonds held by foreign offshore. See, they use the right term, offshore investors. You don't know who it is. They could be Chinese investors. Probably not, though. In the United States, probably yes. But in China, the regulations are different. And the way Chinese investors interact with the Chinese government is different. In the United States, the offshore investors in US treasuries tell the government what to do. In China, the offshore investors, if they get discovered, learn from the Chinese government what they're going to do. So it's probably not offshore Chinese money. This is Chinese government bonds held by other entities, governments and investors. But the important thing is this. Chinese government has 440 billion of US treasuries. Other people, possibly including the US government, have 330 billion of Chinese bonds. So the idea that the Chinese government is somehow or other holding the US treasury hostage and that they could jump on the springboard and we'd all fall into the pool or off the cliff or whatever metaphor you want to use is probably not accurate. It's really much more of a standoff, or as I say, a mutual admiration society. I'll hold your bonds if you hold mine. And it may be a grudgingly held mutual admiration society, but it's like bank robbers. The funky thing about bank robbers is they trust each other. These are inherently dishonest people trusting each other. So it's not a matter of the Chinese government holding the US hostage. It's not a matter that the Chinese government could have a strike on US treasuries and drive the dollar to nothing. That's not the threat. As I said 3 weeks ago when I was talking about this, the real concern is that $2.5 trillion that's estimated by some economists to be held by US corporations, institutional investors, pension funds, and individuals offshore in treasuries, so they don't have to worry about a currency risk, but they get to avoid taxes on the profits that they earn there. And then they take some of those profits and they use them for campaign contributions to people who want to run for president or Senate or representative. And they make sure that those guys know that if they ever try to make a more rational tax code, there's $2.5 trillion worth of T-bonds that might get sold. That's the real risk to the Treasury market. I think that's about all I got for today. I've gone a long time, but there's a lot to cover. As I said, with silver at $100, with silver at $24 and gold at $17.60, $17.70, it's a good time to sort of take a breather and say, where are we in terms of the economy? Where are we in terms of financial markets? Stock markets at record levels. Does that mean it's about to collapse? Probably not. Does it mean that we might have a 10% correction at some point? That's a lot more rational expectation. You can buy our yearbooks online. You can sign up for our retail investment program and get various forms of research and consulting services. We'll have a quarterly open forum on August 25th. The clock's ticking on me for that one, for our clients. And you can watch an introduction to CPM Group at that website. We'll talk to you next week. Have a good weekend in the meantime, and take care.